Good morning, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Dimitri, myself, or Market Chameleon are registered representatives or broker-dealers. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. One last look at the disclaimer, and we'll welcome in Dimitri Pargamonik. How you doing, D?
Good morning, Will. How are you?
Great. What do we have on tap for this morning? Looking at market implied volatility versus actual stock moves, or market implied moves versus actual stock moves?
Yeah. Good morning, everyone. Let me share my screen, and what we'll look at today is a tool that helps us visualize what the market daily implied moves or volatility is based on the option prices, and then we're going to compare that to the actual move the next day to see how well the implied moves anticipated the actual moves. So let's look at an example here, and we'll use SPY. So let's type in SPY here in the search box. And under the menu, you're going to end up here on the summary page. Under the menu, go to volatility.
All right, hold up. I just brought it up. Sorry. There you
go. We're good?
Yep.
All right, so we're on SPY, summary page, and under the menu, volatility, click on implied moves, and we're going to come to this chart. I'm going to close this menu to expand our screen. And what we see here is brackets that are going up and down, and then these green and red bars. The brackets here are the daily implied moves that are derived from the option prices, and that's looking at the options expiration that is the closest expiration to the one day move. So here in SPY we actually have daily options. So it would look at a option straddle, derives the value from the option straddle at the end of the day, at the close, and it looks at that straddle and derives what is the implied move of the stock the next day, right? So the option will expire the following day. If there's no daily option, it'll look at the next option out. It could be weekly, monthly, and it'll derive a daily move based on those options volatility, implied volatilities. So here we see a bracket going up and down from zero, and a straddle, it's implying a move in either direction. So think of it as it's an implied move or a straddle. It doesn't matter up or down. It's the magnitude of the move. So that's what this bracket is, up or down, okay, around unchanged. Now, we have those, if we use those options as the, implied move, the predictor, will I hear you in the back, the keystrokes in the background?
Sorry.
So yep. So those implied moves, we could compare that to the actual move to see how well did those options perform relative to the actual move. You could see here the actual move will be represented by either a green bar or red bar. So red bar is a move to the downside. So yesterday we're down 1.2%. The green bar represents a move to the upside. So if the stock was up that day. And here we could see a couple things, that those daily implied moves are changing over time, right? Like, look at these bars. They're not consistently, predicting the same move, right? The predicting the same magnitude of the moves. Sometimes the implied volatility will go up, so then and the implied daily move increases. Sometimes the implied volatility goes down, and the implied move decreases. Okay, so we could see here where the long bars, that was when the implied move volatility was higher and it was predicting a much larger move. Where the bars are narrow, that indicates that that day the implied volatility was lower, so the predicted move was lower, or the implied move was lower. Then we look at the following day to see what the stock did. And we could see here, that the stock, just from the bars, had up moves, had down moves. And a couple of things kind of just stick out here, that when the bar, like so, exceeds, when the red or green bar exceeds the bracket, goes beyond the bracket, that means the move was higher than the implied move. Okay, it was greater in magnitude than the implied move based on the option prices. So in SPY, if you had like a straddle, 1 day straddle from the previous day, if it was predicting a 1% move, but the stock moved 1.5%, that means the stock moved, by a greater amount than the options predicted. And we could easily now visualize, which days that happened and by the magnitude. So for example, here I'm hovering over it. Yesterday, the actual move was down 1.2%. The straddle, or the implied move, was 0.7%. So that the stock moved by 0.5% more than out of range. Okay, beyond that. We also see that the stock, had quite a bit of moves that exceeded that strat. Here, the one on March 24th, the stock was up 1.8%, while the implied move was 1%, so that exceeded it by 0.8%. So this lets us see that when the stock exceeded, it could have exceeded the move to the upside or downside, right? So it broke in either direction. It's not like just that the volatility is always to the downside where it exceeds the straddle. We see it even to the upside. We had 1, 2, at least 3 instances in our graph here that the move to the upside exceeded the straddle, but we had, 1, this one's close, but 2, 3, 4, 5 moves to the downside that exceed the straddles. So more frequent to the downside, but we see it going in both ways. There's no, at least here visually, I'm not seeing like a clear pattern right now, of lots of up moves or lots of down moves exceeding. So that doesn't stick out. But we do get some insights here of, that up moves and down moves have exceeded the straddle, and that, they were more frequent to the downside so far in this observation set. So let's go down to the table and get some numbers. What if we took the average of all the implieds and the average of all the moves? Okay, so what we're doing is saying, okay, you're not going to get them right every time. You're going to get them wrong, you're going to get them right. But how much did the implied moves error from the actual, right? What is the error? Is it great? Is it small? And which way did it error? Did it error from the standpoint that it overestimated the move? Because obviously there was a lot of small moves here. Like over here, March 21st, the implied move was 1.2%, but the actual move was unchanged. Well, that's an error of 1.2%. It overestimated, 0 versus a move of 1.2%. So that's where the move was overestimated. A move was underestimated over here. For example, the actual move was 1.2%, while the implied move was 0.7. So the move was much greater. The options underestimated that move. Well, so it's not getting it right. You're not going to get it right on exact, right? So this is we're looking at the averages, right? Over time, you're going to get some overestimate, some underestimate. What did it tend, on average to do over time? So let's look at that first. We're going to come down here, and here's the average of the implied moves. Okay, so the average of the implied moves was 1.3%. Well, how did that compare to the average of the absolute moves? So if we converted all the moves to in absolute terms, positive, right? Because what we're trying to measure is, did the magnitude of the move exceeded, or was it greater or less than the anticipated move? So we took the average of all the actual moves, 1.2%. So you could see they're close, even though sometimes it went above, sometimes below, but over time they're actually pretty close. Slightly, what this has shown is that slightly there's an overestimate. Okay, where we got 1.3 versus 1.2 is 0.1% differential. So it did tend to overestimate slightly the move, which kind of makes anyway. Typically you'll see that because there's always something unexpected, that you could get this big outlier. But in this data set, it's slightly overestimated. So how many days, out of, we're taking 20, this is looking at the last 20 trading days a month. How many days did it overestimate versus underestimate? So this is days inside the range. Inside the range would be something like this, where the move didn't exceed the expected range, right? It was within. And the days that was outside the range, so those were 11 days. 11 out of the 20 would look something like this. Those were inside. 9 of those days, the stock moved outside that implied range. Like over here, over here. And so this is saying it's almost close, at least in this data set, the frequency of within, frequency outside, it's close. More days it closed. The stock movement for the day was less, but it's still 11 versus 9. And down here we could see the daily observations. It's a reflection of this. Here's where the last price of the stock was. What was the move implied the previous day? 0.7%. The actual move was down 1.2%. Did that stay within the 0.7% range? No, it exceeded it, right? March 25th, for that day, the implied move was 0.8% up or down. The actual move was 0.2. Did it stay within the range? Yes, right? It stayed below that 0.8%. So here we could kind of even see if there was any, we could visually see this, or if we see lots of yeses in a row, lots of no's in a row. That's kind of what we're looking through the data. And the other thing here, it's not like very, obvious, but when we're looking at it and thinking about things as far as like skew goes of upside to downside, because when we look at options, there's also skew, right? Skew is like where there are strikes, different strikes within the same expiration, but they have different implied volatilities. Those different implied volatilities are reflecting a skew. For example, if implied volatilities are downside strikes are higher than upside strikes, that implies that there's a greater skew of a movement to the downside, and that the upside moves will be more muted. They could be the same. Sometimes you have a straight skew where the implied volatility across the board could be flat. Let's say 20 across the board on each strike. Other times you could have a reverse skew where the upside strikes have a higher implied volatility than the downside strikes. I just did an article on one of them actually in Baidu that's happening. Or you could have a smile where both the upside and downside, the skew is higher relative to the at the monies. But this helps us at least to visualize the actual moves, how the stock moved. And here we could see that the upside moves, at least in magnitude visually, we could go back and calculate, but the upside moves here could be just as volatile as some of the downside moves. Maybe if we just looked at the most extreme 2.7 versus 2.1, the downside moves here are a little bit greater, but the downside moves that exceeded the range, right, appeared to have been more frequent than the upside moves. So maybe, some sort of downside skew here, just visually is justified relative to the upside. So just visually, it looks like maybe, the liquidity, if we're measuring upside and downside liquidity, that some of these downside moves were a little bit less liquid than the upside moves. So I think I'm going to stop right there because I think I covered this whole page at this point.
That was excellent, D. Thank you very much. Thanks for bringing this webinar to the Chameleon community. Everyone, thank you for joining us. Remember to like us, follow us, and on all the platforms out there, but particularly YouTube because we're there now. Thumbs up are always appreciated. Great job as always, D. Have a great trading day, and we'll see everyone tomorrow. Thanks, buddy.
Thanks, everyone. Have a great trading day, and we hope to see you tomorrow morning.
Trade in peace, chameleons. Bye.